Hello everybody, welcome to Know Your Money. I'm Bronwyn Weiner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast. Welcome, Clive Lazar from Just Retirement. Thanks for coming to our studio. And I'd like to introduce yourself. And who is Just Retirement? Some of our listeners may not have heard of your company, which we use extensively in our practice.
Good morning. Yes, thanks so much, Craig. My name is Clive Lazar. I'm the Regional Manager for Just Retirement. Just Retirement is a long-term insurer in South Africa, licensed and regulated to offer long-term insurance products, specifically what we refer to as life annuities. A life annuity is policy that is taken out using a lump sum of capital, and that then is paid over to an insurer like Just, who in turn will pay a monthly income or pension to a client for their lifetime, hence the name life annuity, an annuity for the client's lifetime. And that's what we provide. Just Retirement has been operating in South Africa for over 10 years. And it's important to note that we are 100% owned by the Just Group. The Just Group is a licensed and listed insurer in the UK, part of the FTSE top 200 companies, and they entered the South African market about 10 years ago, where they felt there was an opportunity to differentiate products and features to the normal traditional long-term insurance products that are offered.
Now, Just Retirement, when they came to South Africa, how did they enter the market? What was who introduced them? How do they? It's difficult to enter a very saturated, mature market, especially in the life world of the big insurers. We've got some incredible insurers here, Old Mutual, Liberty, Sanlam, etc., that are doing very well in the market. So how did you guys enter the market, and was it easy? Did you come in the back of somebody else?
Yeah, that's a great question. So our CEO, Dean Moore, had been running the Momentum, the MMR life annuity product, specifically the with-profit annuity, and felt there was a gap in the South African market, specifically in terms of some of the life annuity features. And what he did was he went to the UK and found some funding from the Just Group, who felt there was definitely an opportunity to enter the market. So obviously, as an insurer, one needs to have the necessary capital behind you. So with that capital and that funding, we were able to set up the business here in South Africa as a long-term insurer, and slowly build a brand and a name so that we can start to compete with the other insurers, the well-known insurers like Mutual, Sanlam and Liberty. Important to point out that all insurers are regulated by the Prudential Authority, and so even though Just is a small insurer in South Africa, we comply with all the necessary legal and regulatory requirements as an insurer. Also important to point out that insurers are assessed according to what we call a default credit rating. So what is the likelihood that the insurer is able to continue to pay their policyholders their income for their lifetime? And rating agencies, for example, Fitch, as a well-known rating agency, provides a default credit rating for all the different insurers. Because we are a UK listed insurer, we have a default credit rating of A on the international scale. So that obviously should provide some comfort to clients here in South Africa, knowing that you've got a default credit rating of A, which is actually higher than any of the other local insurers.
I think over the years, we've never had an insurance company go belly up in that respect where they haven't paid the annuity. If that ever did happen, as you say, the regulation is very strong in South Africa, and another insurer would pick up the pieces. But in your case, you've got the backing of a massive UK company, which is a positive for any annuitant. Because you say, well, I've given you my capital, you're going to pay me for life, or will you be around in the next 20 years? And I think that's a really good point, that there's a huge backing behind you.
And then also just in terms of that paying a percent, a salary for life, are your rates competitive, or are they, does everyone have to kind of have the same rate? So let's say it's R1 million, is it 5,000 Rand a month? How does that sort of work to unpack that a bit?
So when it comes to a life annuity, the majority or most or all insurers in South Africa use the standard criteria of your age, your gender, and what we call your fund credit, the amount of money that you are bringing forward from your retirement fund or from discretionary money to use to purchase that annuity. So those are standard criteria. Your age, obviously age is important because the younger you are, the longer your life expectancy, which means the insurer's got to factor in the lifetime that's got to pay you that annuity for. Gender is important because males and females, according to probabilities and statistics, live different periods. For example, if somebody who comes to us at 65 is a male, we expect them to live to, on average, 82. So that's 17 years. Whereas if you come to us as a female at 65, we expect you to live to, on average, 87. So that's an additional, 4 years, making it 22 years, meaning females live longer on average than males. So that's got to be factored in. And then your fund credit is important because that, to a certain extent, puts you into a certain, let's call it demographic profile. If you're retiring with 1 million or you're retiring with 10 million. So those are the standard criteria that all insurers utilize to price the annuity. The difference from our perspective is we take it one step further. So in addition to those criteria, what we also do is we look at your household income. So that's important, as well as your qualification. That's what we call some additional socioeconomic factors that we factor in. And then a further aspect that we do that no other insurer in South Africa does is that we will take it one step further and look at your medical history, so your lifestyle, your background in terms of have you had any medical conditions, any kind of medical impairment, etc., because then we'll factor that as well into the price of the annuity. So that is one additional aspect that we do as an insurer.
Okay.
I think we'll take that to another episode, the underwriting, which is unique.
So you're saying if you're retiring with that money, but then you also mentioned discretionary money. So how would that work? Like, if someone passed away and they got this huge inheritance, but now they want to try and make sure that they have an income for life, is that the type of person that would come? Or what have you found people use their discretionary money for that product?
Just to tell the listeners, discretionary money isn't money that comes out of a retirement annuity or a pension fund that you're forced to buy an annuity or a pension. Discretionary money, as Bronwyn says, you sell a business, your life policy pays out, you've got a lump sum of money to invest at your own discretion. You can invest wherever you like. So will they come to just in that instance?
Or why should they?
So a life annuity, which we're talking about, can be purchased with either compulsory or discretionary money. Discretionary money, as you've indicated, proceeds of the sale of a house and the sale of a business, or often what we see is when it comes to retirement, as one knows, you can have your tax-free portion, your 550,000 Rand that you're allowed to take tax-free from your retirement fund. That can also be used, and that is discretionary money, to buy a life annuity. And we do see a number of clients who come to us who want to buy a life annuity with discretionary money. Why would they do that? Well, there is a very strong tax advantage with buying a life annuity with discretionary money, in the sense that a large component of the income that we pay, and when I say a large component, I'm talking in the order of about 65% of that income is considered tax-free. So it's considered to be a repayment of your own capital, and it's only the interest portion that is then subject to tax. So it's quite a tax-efficient way of structuring an income stream with your tax-free portion. Also, it's worth pointing out that it depends on the type of life annuity that you buy with discretionary money. So, for example, if you buy a life annuity where there's a fixed escalation, for example, like a 5 or 6% fixed escalation.
So by fixed escalation, you mean it's 5,000 Rand this month, this year, and next year it will go up by 5%. Is that what you...
Exactly. That's what we mean by fixed escalation. So there's also a difference in the tax treatment of a life annuity if it's a fixed escalation or if it's an unknown increase. For example, if you buy a CPI-linked annuity, CPI meaning an inflation-linked annuity, or a with-profit annuity, and I know we're going to talk a little bit more about what a with-profit is, but when you buy a life annuity where the increase is unknown, it depends on what the inflation rate is or what the investment markets deliver, that becomes an even more tax efficient life annuity, because instead of about 60% being tax-free, it goes up to around 90% as tax-free. So it's just worth distinguishing the difference between an known and an unknown increase.
So I think those type of products we're going to unpack in the next few series, Clive. But thank you for telling us who Just Retirement is, and we'll look forward to hearing about the product in the next episode. Thank you.
It's a pleasure.
Cheers. Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.